Welcome back to Next Gen Investing. As we know, headlines have been driven by some of the volatility we've seen overseas, specifically in how it relates to, of course, the oil market and how that supply buffer and the impact of higher energy prices could impact, of course, growth expectations for this year. So for more about how these factors could play into the Fed and inflation, we're now joined by Dryden Pence, Chief Investment Officer at Pence Capital Management. Dryden, thanks so much for joining us to help us kick off the trading week. So first and foremost, do you see the Iran conflict disrupting oil supply in a way that could really change the growth outlook for the year?
I think the current conflict, it's not a supply issue. This is not a production issue. This is not a supply issue. It's a transportation issue. The world going into this was oversupplied by about 2 to 4 billion barrels a day. Even if you take all of Iran off, we only become slightly undersupplied. This is a transportation issue with the impediment to the Gulf Straits of Hormuz. And that can be fixed pretty quickly. So this is different than back during the Ukraine war. This is different than some of the other problems that we had in the past because those were supply constraints. This isn't. This is transportation, and it probably clears up fairly quickly once hostilities begin to slow down. But, you know, in the end, the U.S. Fifth Fleet can clear the Straits of Hormuz and open it up if they need to.
Dryden, I like this perspective. It kind of welcomes and highlights the key differences between kind of prior instances that are going to naturally be compared to. But when you look at the market reaction, just from a finance and trading standpoint, oftentimes cooler heads do not prevail initially, and they, very reactionary. Perhaps they're short covering. Things get out of control. You saw that a little bit overnight. But with chatter of the G7 perhaps opening up reserves to sort of jawbone things back down, do you think currently, if we were to kind of stay in this mid-90s, this is sort of the peak of where we actually trade, this is something that can be stomached by the market, or is it still too much too quick?
Well, the question is stomached by the market or stomached by the economy. $80 oil, we're okay. $90, it's a little tight. 100's a little recessionary. 120's kind of a problem. But I think at this point, this is a short-term set of circumstances. This is not production. Again, this is transportation, and that can be fixed pretty quick. So I think there was a lot of overreaction. When you see the market, spike up 20% overnight, that's a lot of overreaction here, and we're solving a lot of the problems. The ability to insure, getting the ships through the Straits of Hormuz, the ability. We've done this before. We've done escort runs. The Fifth Fleet knows how to do that. So I think that as we get further into the next week or two of the war, you'll be able to see this begin to open up. So you're exactly right. There was some overreaction, and these people that were buying at 120 are probably going to regret it because I think that the problem is you're going to have this settle down fairly quickly.
Okay, and so how do oil prices, if at any, complicate some of the Fed's inflation narrative over the next, few CPI and PCE prints?
Well, you're going to have a CPI number come out here pretty quick, but that's not going to be affected by this, right? So you're going to see a benign CPI number when it comes out. You're going to probably have some Fed decisions around that near the end of the month, but they're functioning off old data. Now, March data is going to be rough. April data may be a little rough, but the key thing that is there is by the time we get to that, prices will probably be back down stable again. So if you see a kick in the CPI a little bit, it'll be for a relatively short period of time. Again, March data is going to be ugly because oil prices are going to pick up. But the U.S. in and of itself, from a supply point, we're pretty insulated. We only get 2% of our oil through the Straits of Hormuz anyway. The rest of the world's going to have a problem. But again, it's fairly short. And so we'll have 1 month, maybe 2 months of bad data, but then it'll settle back down, we think. And the Fed's got a challenge, right? Do they wait or do they move? And I think that they're going to have to parse this out. But they're going to see a benign CPI number coming up because it's month-old data.
Dryden, before we get into some of your energy picks and why you're looking at those names, kind of building on what Jenny asked here as we look out and we decide, okay, what is the impact on the economy of this price shock that we're seeing? And is the question just how long it lasts? And so I'll pose it this way then, Dryden. How long would this have to go before you get really worried? And is it beyond that 2-month time frame that you just laid out?
Yeah, I think you'd have to see beyond 2 months. You'd have to see prices in the U.S. begin to go up for gasoline and stay there for a sustained period of time. You know, if we're still having combat operations at the level we're having them today, 90 days from now, we've probably run out of targets to hit. So I think that probably this thing again is over fairly soon. I don't think it severely affects our view on the economy or our view on the markets, that both the economy and the markets are going to be reasonably good this year. We still have a lot of stimulus coming into the market. We still have an economy that's reasonably solid. And I think that both of those things are still positive. It doesn't change our overall view. This is a 60, 90-day hiccup at worst. I think it's probably even less than that.
Okay, and so I wanted to get to some of your picks, like some of these integrated majors like ExxonMobil, Chevron. Why do these names stand out over the pure exploration and production names?
Well, I mean, the thing is, because you're going to have oil prices elevated for a little while, the integrateds have the ability to grab money from multiple places, and this is good for them. I mean, Exxon produces more oil than Iran does. And Chevron produces more money than Kuwait. You're talking about the 6th largest producer and the 10th largest producer in the world. So this price elevation on a short period of time is going to be accretive to earnings pretty quick, and that's going to be good for them. But also, because they're integrated and because they're throughout this entire process, they're going to be able to insulate themselves from any negatives and maximize the benefit of any positives that are coming out of this.
Dryden, then last thing, as we kind of look at that, is there a part of the energy market you would avoid investment in? You talked about, buying the oil at 120 if you were one of the people doing that overnight, probably regretting that. Is there any parts of the energy sector that you'd avoid?
I think the big thing to avoid at this point is for an individual investor, is trying to get in and play this on an over-speculative basis and reacting to whatever news story it is. You're going to hear news stories on Carg Island. You're going to hear news stories of ships being targeted. All of this is just going to create some volatility. But if you're expecting sustained oil prices north of $100 and making your investment decisions on that, you're probably making a mistake. Again, this is not a supply issue, it's a transportation one, and those get solved in a reasonable period of time. So the thing for investors to do is avoid overreacting to what is ostensibly a short-term set of circumstances.
Okay, and I like that. I feel like there's so much doom and gloom right now in the headlines. I like to hear that it could be perhaps an overreaction, because that's a much better stance than saying it's an underreaction, I guess, at this point. But so appreciate it. Really great commentary to kick off our week. Dryden Pence, Chief Investment Officer at Pence Capital Management. Now,